What's up, guys? Welcome to today's video. Hope you guys are all having a great holiday weekend. It's currently Christmas Eve right now. It's about 7 o'clock in the evening. I just got back from the gym, and before that I actually went and checked on the Mesa flip. Everything is looking good. I had to go pay the drywall guy and make sure his work was quality. Everything looks really good though. That was kind of the only holdup, so now hopefully things will start to really get going and we'll start to progress a lot faster now that the drywall is done. But today's video is actually going to be talking about a very popular real estate investing method. I know a lot of you guys have probably heard of it. It's all over YouTube. It's called the BRRRR Method. I'm going to break it down in the way that I see it and the way that I understand it and the way that I would actually utilize it myself. So I hope this video is able to help you guys. It's actually a very, very good approach for someone that doesn't have a lot of money for a down payment. It's a very inexpensive way to start building up your rental portfolio or your investment portfolio as a real estate investor, because it requires a lot less down payment and sometimes even none of your own money whatsoever if you do this right. I actually did this specific method on one of my properties, so I can actually give you guys a real life example from my specific situation on how I use this method, and I hope this video is able to help you guys out. Before we get started though, as a lot of you guys know, I am a licensed real estate agent here in the Arizona area. For those of you guys that are interested in investing in Arizona specifically, message me down below. My email will be down below. I love to work with some of you guys. I read actually an incredible statistic last night when I was doing a lot of research in the Arizona market. I read that in 2018, December 2018, we had double the amount of active listings as we do now, and we had half the amount of sales. To break it down in a different way, we have way less inventory, active inventory right now. We have half the amount of active listings that we did in 2018, exactly 2 years ago, but we sold double the amount of properties, which means a lot less supply and we have a lot more demand going on. So it just goes to show that the Arizona market and kind of the real estate market right now in general is extremely hot. Prices are going up because interest rates are so low. So now is a very, very good time to get into it because you guys can lock up an extremely low interest rate. Now, I guess the best way to start this video is breaking down what the BRRRR method is. It is buy, renovate, rent, refinance, repeat. Now, this is exactly what I did on my third rental property. Actually, I'm going to get into that a little bit later in this video, but I kind of want to break down each specific point that I just mentioned and kind of go into a little bit more detail on it. So obviously, the first thing you're going to do if you want to get into real estate investing is you're going to have to buy a property. That's where the B comes from. Now, for those guys that don't know, as an investment property, the banks or lenders that you're going to go to are generally going to require, they pretty much are going to require 20% down. I'm actually seeing a lot more lenders and banks require 25% down on some investment properties now, just because things are so busy. Now, this approach actually undercuts that 20% down and allows you to put a lot less down on a property while still using it as an investment property. So it's a lot more attainable for someone that doesn't have that much money sitting around where you can put 20-25% down. So the first thing that you're gonna do in the buying process is you're gonna have to live in this property for 1 year. The first year you're gonna have to live in it. You living in this property for 1 year allows you to undercut that 20% because it's going to be an owner occupancy loan, which allows you to put as little as 3.5% down. But for this example, it allows you to put, let's say, a 5% down conventional loan. Now that is an insane price cut. If you guys have to go from 25% down to 5% down on a $400,000 house, that's close to $70,000, $80,000 after closing costs that you don't have to come out of pocket on. And it's just because it's an owner occupancy loan, which the banks will allow you to have a much less down payment, and it'll also be a much smaller or lower interest rate as well because they see you as less of a risk because you're actually living at the property. So that's the first step. You're gonna have to get an owner occupancy loan, and in order to get that loan, you're gonna have to live on the property. Now, let's say you buy that property, you get that 5% down, you're gonna live in it for a year. The next step that you're gonna do is renovate. So you're gonna buy it, you're gonna renovate it. Now, the reason why you're gonna renovate a property with this specific method is because it allows you to get more built-in equity into the property, so then you can refinance later and pull out your own money. This is where it kind of gets confusing, but for those of you guys that don't know, anything under with the conventional loan and government and the FHA loan, which is the most popular government-backed loan, if you don't have 20% equity into the property, then you're gonna have to pay something called mortgage insurance premium. It's basically an extra tacked on. It could definitely equal up to a couple $100s a month onto your mortgage extra. It's just simply insurance for the lender or the bank that loaned you money. It's just so you don't default on your loan, or if you do, they have that little bit of insurance cushion that they got the extra couple $100s a month tacked on your mortgage. This doesn't contribute to anything whatsoever, so it's kind of like you're wishing away in the wind a couple $100s a month just for this insurance premium. And the only way to get rid of this insurance premium is once you pass that 20% threshold of equity into that property. Now, that doesn't mean you have to have 20% of your own money. It doesn't mean you have to pull 20% out of your bank account in order to get that equity. There's a couple ways that you can do this. You can either buy an under market value property, which is what I did specifically for my third rental. I bought it for $290,000. 1 week later, it appraised for $330,000. So technically, that $290,000 and $330,000, there's a $40,000 difference. That $40,000 difference is considered my equity into the property, and it's not my own money, but it's considered equity. So if I went and sold that property, that $40,000 would go to me because I bought it for $290,000. I sell it for $330,000. I'm going to get the $40,000. The banks will consider that equity into your property. So that can be a very good approach if you don't want to put your own money down. You can find a really good deal on the market or off the market and use that equity that was built in as your 20% threshold, and that will get rid of all your mortgage insurance premium. You can also just simply wait for your property to appreciate over 20%. A lot of people do this, but this takes a little bit longer. Obviously, in a market like this, you may be able to do that in 1, 2, 3 years just because the market's appreciating so much. This year alone, we've seen almost an 18% increase. So if you bought your house at the beginning of the year and you refinance right now, you probably end up actually passing that 20% threshold just based on appreciation of your property without doing anything whatsoever to it. But this isn't always the case with a market that's a little bit slower. You may have to wait a little bit while longer in order to refinance to get rid of that mortgage insurance premium if you're simply just waiting for your property to appreciate. And the third way to do this, and a very, very popular way to get that equity in your property, is simply just upgrade your property, to renovate it, to have it once you go to refinance it, it appraises higher because you put in sweat equity into it, because you upgraded the property a lot more. Whether that be a fresh coat of paint, whether that be granite countertops, flooring. Sometimes the lenders will require you to prove what you did to actually appreciate the house, but some appraisers don't care. They'll just go in and they'll appraise it. You can actually combine all these together as well. You can buy an under market value property. This is actually kind of the whole concept of flipping. You buy an under market value property, so you already have built-in equity. You then renovate it, which gives you even more equity, and then you just refinance it or sell it if you're gonna flip it. But I prefer to refinance and just hold on to all these properties. Now, you don't have to refinance a property. If you're fine with having that 5% down and leaving that 5% of your down payment in there, and you don't wanna pull out your own cash to do this again, then you don't have to refinance it. But I do recommend refinancing once you reach that 20% threshold, because it will get rid of your mortgage insurance premium. And I've seen mortgage insurance premiums as high as a couple $100s a month. So if you're trying to rent this property down the road, $200, $300, $400 a month of just useless insurance is going to really eat into your cash flow. So I do recommend, if you are going to rent it out, to kind of to refinance once you pass that 20% threshold. Now, this is going to get really confusing here, but there's something called a cash out refinance. And basically, the bank is only going to need 20% of your equity into the property. So if you have 40% of your own equity into the property, you can actually pull out that 20% and bring your equity back down to that 20%, and you can put all that back in your bank account. This can be a really good approach as well if you guys want to pull out some money on one property and use that money that you're pulling out to buy another property. Very, very possible situation, and a lot of people do this as well. For my example, I actually owned originally about 38% of my property, and I didn't want to pay any more out of pocket when I refinanced, so I actually used some of that 38%, and instead of paying for closing costs, I had them put my closing costs into the loan, which brought down my equity into the property to about 33%, I think, but I didn't have to come out of pocket on it. So that's another really good approach too. You guys can do a cash out refinance if you have more than 20% equity into the property. Now, if you guys aren't hurting for money, or you guys have enough money in your bank account where you don't need that 20% equity, I would just leave it in. This is for someone that wants to use that specific money or use that equity into a property to maybe buy another one. But if you're just pulling out that 20%, then just let it sit in your bank account. I don't recommend doing that, because the bigger loan that you have, the higher interest rate, or not the higher interest rate, but the more interest that you're going to be paying on the loan long term. So hopefully this is making sense. So we bought the property, we renovated the property, we refinanced the property to get out of that mortgage insurance premium or to pull equity out. and then we're gonna rent it out. You can rent it out before you refinance. It doesn't really matter. I actually rented it out before I refinance. You're gonna rent it out. You have to wait a year in order to rent this property, because remember, this is an owner occupancy loan, so you do have to wait. So you're gonna rent the property out. One thing you do want to make sure when you're doing this BRRRR method is rent it out and actually have positive cash flow on it. Because if you don't have positive cash flow, first of all, it's not the best investment unless you're strictly basing it on hoping for appreciation of the property. You want to make sure that you do have positive cash flow, because when you go to refinance the property, the banks are actually going to want that lease statement. They're going to want the lease agreement, and they're going to compare it to your mortgage. So if that lease agreement is $1,800 a month, but your mortgage is $2,000, you're going to have a negative $200 a month that's going to eat into your debt to income ratio. So you do want to make sure you're cash flowing when you do go to rent it out. Once you rent this property out, you simply move on, you repeat the process, you buy another property, you live in it for a year, you live in it for 2 years, you do the same sort of thing, you renovate it, you refinance, you pull some money out if you want to, you can leave your money in, you can get rid of the mortgage insurance premium, and then you can just live in there for a couple years if you want. Repeat the process. Do the same thing. You can continue to build up properties with smaller down payments because you're going to be living in it. I actually put 20% down on my rental, so that's the only thing that's different, is I didn't need to actually live there because I put 20% down anyways, which is why I'm actually at this house right now and not my rental property. So I actually skipped that step of living there for a year, and I simply just straight up rented it out. Now, if I would have put 5% down, I would have had to have lived there. If I would have lived there, I would have just house hacked it, and I would have rented out the other 2 rooms anyways, and hopefully cash flowed a little bit on it. But right now, that house that I have is strictly just being rented out. But a lot of people do this. They live in a house for 1, 2, 3 years. They renovate it, and then they just simply move on to even a bigger, better house, or you can just keep it at the same level house. You can keep all your houses at $300,000, or you can slowly build up to a bigger house until you're at your dream house. Another thing that I always tell my clients, if you're looking to buy your first property, this doesn't always have to be your dream home, guys. Just look for a good deal, live in it for a year. You're not going to live in it for the rest of your life, and move on from it. You can slowly build up to your dream house, which is what I'm doing right now. You don't have to jump into the perfect house. If the price is right, if it looks like a good deal, if you ran your numbers, if the cash flow is good, take that risk, get out of your comfort zone, live in there for a year. If you hate living there, it's only gonna be a year. You can rent it out, and then you can move on to the next one and you learn your lesson. So I hope this video wasn't too confusing, guys. I kind of confused myself filming it. But if you guys ever do have any questions about these videos, comment down below. I'd love to respond to you guys. I love when you guys comment. I love when you guys drop likes. Thank you so much for supporting me in 2020 as well. I know it's been an insane year. 2021 will be hopefully better for everyone. Overall, mental health, physical health, investing, whether it be real estate investing, stock market investing, any sort of financial stuff. I wish you guys the best in 2020, in 2021, excuse me. Thank you guys so much for the support. Alright guys, I just finished filming this video, but I probably should touch on a lot of people that use this BRRRR method actually get hard money lenders or private lenders, and that's the reason they actually refinance out of a property, because they're going to refinance into a normal conventional bank loan, 30-year fixed rate mortgage, and get out of that high interest private loan that they have that's probably quadruple the amount of interest that a normal bank loan is. This is actually what I did specifically on my property. I got a hard money or private money loan from my business partner, so we bought the house cash. I paid him off by refinancing, and I refinanced with a traditional 30-year fixed rate mortgage with a bank that was a much lower interest rate, and basically that bank took over his loan, paid him off, got him out of the deal, and now I'm with a 30-year fixed rate loan. So this is another approach if you guys are using private money or hard money lenders. This hard money approach is a lot riskier because you have to refinance out of that loan, or you are stuck with an extremely high interest rate, and most likely they have short loan terms, which requires you to pay it all in a lump sum at the end of that loan term. So you do want to make sure you run your numbers, and you do want to make sure you can refinance on that property, because if the bank's not going to refinance and you don't have enough equity into that property, all the difference that you're going to have to come up with is going to have to come out of your pocket. So if you are using hard money lenders, just be sure to be careful with it. It's a very good approach. It's the only reason why I have that house over there right now, but it's also a lot riskier as well. So if you guys are interested in that approach, I would look more into hard money lenders and stuff like that, so you guys can learn a little bit more about that. But I just did want to touch base on that, because a lot of people that do use this BRRRR method do use hard money lenders at first, and that's why they refinance out of it.